The invisible thief. How inflation impacts investors at every stage. Inflation, often referred to as the silent thief of purchasing power, has a pervasive impact on daily finances and investment strategies. Its effects are felt by investors at various stages, from newcomers to experienced market players, early retirees, and those near retirement. In this article, we explore how inflation influences daily finances and the specific challenges it poses for different investor groups. Effects of inflation on daily finances. Inflation refers to the gradual increase in the general price level of goods and services. Its consequences ripple through various aspects of daily finances. Purchasing power erosion. Inflation erodes the purchasing power of money over time. What you could buy for $100 last year may cost $105 or more this year, reducing the real value of your money. Budget constraints. Rising prices constrain your budget, leading to cutbacks in discretionary spending or causing difficulties in maintaining your standard of living. Savings impact. Inflation undermines the value of your savings. If your savings or investments don't keep pace with inflation, you effectively losing money in real terms. Interest rates. Central banks may raise interest rates to combat inflation, affecting borrowing costs and potentially impacting mortgage payments, credit card debt, and other loans. Now, let's explore how inflation affects different groups of investors. 1. New investors. New investors may underestimate the impact of inflation. If they aren't proactive about investing and saving, their cash may lose value over time. It's crucial for them to start investing early to potentially outpace inflation and build wealth. 2. Experienced investors. Experienced investors have likely witnessed the effects of inflation and understand the importance of diversified portfolios. They may need to adjust their investment strategies to account for inflation's impact on their wealth. 3. Investors trying to retire early. For those pursuing early retirement, inflation can be a significant challenge. Their investments need to generate enough returns to sustain them over a more extended retirement period, which means taking inflation into account in their planning is crucial. 4. Investors near retirement. Investors approaching retirement must also be vigilant. They should consider investments that offer inflation protection, such as stocks, real estate, or inflation-linked bonds. These assets have historically demonstrated resilience against rising prices. Strategies to mitigate inflation's impact. Diversification. Diversify your investment portfolio to include assets that historically perform well during inflationary periods, such as stocks and real assets like real estate and commodities. Tips. Treasury inflation-protected securities. Consider TIPS, which provide a guaranteed return above inflation. These can be a valuable addition to a retirement portfolio. Stock investments. Stocks have historically outpaced inflation. Quality dividend-paying stocks can provide an income stream that keeps pace with or exceeds rising prices. Regular monitoring. Regularly review your investment portfolio, income sources, and spending patterns to ensure they align with your financial goals and the prevailing economic conditions. Budgeting and saving. Maintain a budget that factors in inflation. Consistent saving and budget adjustments can help preserve your financial stability. Conclusion. In conclusion, inflation is an ever-present factor in the financial landscape, impacting daily finances and investment strategies. It's essential for investors at every stage to acknowledge and address the effects of inflation in their financial planning to protect their wealth and achieve their long-term goals.